Mr. President, I know you love to buy shit. Let's buy Qatar. Today I present a purely economical analysis and a real proposal. The United States should acquire Qatar. Let's buy it. We can pay $4 million per citizen and integrate it to the United States. It's probably worth $10 million per person, so that's a deal. And the people in Qatar will never have to work again. I think they'll love it. It's not a political argument. It's a valuation exercise. Step 1, purchase price. I'd say the Qatari citizens are around 330,000. Let's offer them $4 million per citizen. Total acquisition cost, some measly $1.32 trillion. You've got that. Put that into perspective. That's roughly 5% of U.S. GDP, a fraction of total U.S. national wealth, comparable to several years of federal deficits. Large, but financially within U.S. borrowing capacity. Step 2. What is being acquired? Qatar controls part of the North Field, one of the largest natural gas reserves in the world. Approximately 25 billion barrels of oil reserves, major LNG export terminals, global energy contracts extending decades, a sovereign wealth fund estimated at nearly $500 billion. Using discounted cash flow valuation over long-term production, conservative modeling can place a total long-term duration asset in the low single-digit trillions. For this analysis, let's assume estimated long-term asset value at $3 trillion. The United States pays $1.32 trillion for assets worth $3 trillion over time. The implied gross asset spread is about $1.7 trillion. That is the central economic rationale. Step 3, financing the acquisition. If financing through long-term treasury bonds at 4 to 5%, annual interest costs about $1.32 trillion, approximately $65 billion per year. Energy export revenues from LNG and oil could offset part of the cost. In theory, the assets could function like a long-duration revenue production investment. Step 4, citizen economic outcome. Each citizen receives $4 million. An investment conservatively at 5% is $200,000 a year. For many households, wage labor becomes optional. The payout converts national hydrocarbon wealth into personal capital wealth. Step 5, strategic economic gains for the U.S. Potential benefits include expanded control over global LNG supply, strengthening energy export position, direct ownership of long-term hydrocarbon revenue streams, increased geopolitical leverage in energy markets, diversified federal asset holdings. Energy remains a foundational input to industrial production and national defense. Step 6, any economic model must include reserve valuation risk. Future gas demand may decline with global energy transition. Political risk. Sovereign integration would alter regional dynamics. Asset liquidity. Hydrocarbon reserves are long-term cash flows, not immediate cash. Opportunity cost. $1.32 trillion deployed elsewhere may yield alternative returns. But market reaction. Global capital markets reprice large structural shifts quickly. Historical precedents. The United States has acquired territories before. Louisiana Purchase, Alaska. Both transactions later proved economically beneficial due to resource development. The scale today is larger. The markets are faster. The risks transmit globally. Economic conclusion? Well, if one assumes long-term energy demands remain strong, reserves are accurately valued, financing remains stable, integration costs are contained, then paying $4 million per citizen, totaling $1.32 trillion for an asset base plausibly valued near $3 trillion can be modeled as financially accretive. The citizens receive generation wealth. The United States acquires long-duration productive assets. On a spreadsheet under optimistic assumptions, it can be framed as a favorable transaction. Whether it is feasible politically or strategically is outside the economic model. You don't give a shit anyways. So, from a valuation standpoint, the arithmetic is clear. Come on, Mr. President, let's buy Qatar. Let's get it.